Hi, I'm Tate Parker, and I help business owners and financial managers protect their cash flow, access more capital, weather economic storms, and manage unforeseen risks by ensuring their accounts receivable. Today we're going to talk about the accessing more capital part. Have you ever wanted more favorable financing terms with your bank? Well, let's define what we mean by that. Usually that comes down to one or two of about three different things. Either having more eligibility on your working capital line of credit, having a higher advance rate, or having less side collateral in the form of real estate, restrictive covenants, or corporate guarantees. Essentially what this usually means is we have classes of receivables that we can't borrow on that we'd like to be able to in order to give us the cash flow and the working capital we need. Foreign receivables, sales concentrations, things like that. So the end result of more favorable financing, as we're describing it here, is helping the bank feel more comfortable stretching on limits, terms, and conditions. Let me tell you a quick story. I had a banker introduce me to a client several years ago that was a small company. They were growing, but they had about 80% of their business with one customer, and they needed an increase in their line of credit to support their growth. The bank was having trouble figuring out how to get this done because of the large concentration with one customer. They introduced me to the client. We began to insure their receivables, and coincidentally, about 6 months in, that large account filed bankruptcy, but we paid the claim and made the bank and the business very happy. Fast forward a few years, and the owner of that company called me and said, "Hey, I've got a separate business. It's much larger. We're growing very quickly. I'd like to see if insuring these receivables would help me in this business as well." And we put together a program that would do that. The company essentially is a service business that has receivables as almost their only asset. And by insuring those, the company has been able to access relatively low-cost bank capital to facilitate growth, and they've now increased their sales over 500%. And in the process, the owner told me recently that saved him about $1.2 million in financing costs as compared to having more expensive forms of capital in their business. If this would help you, or if you'd like to learn more about how to use credit insurance to help your bank give you more favorable terms, click on the link below.